investing, you don't need to be near the property. You don't even need to see the property ever. Um, and so you can invest anywhere you want.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Fred Moskowitz. Fred, how are you doing today?
Doing fabulous. Thanks for having me on, Todd.
Yeah, absolutely. Really appreciate it. And Fred is a sought-after speaker, advisor, trainer, and Fred combines his expertise in investing with his experience as an entrepreneur to help people attain a higher level of financial literacy, providing value to aspiring investors from all walks of life. He's got a new book, The Little Green Book of Note Investing, and we'll be diving into that book and diving into note investing. And encourages readers to diversify and learn all about the asset of note investing. So, with that said, there's a lot more about you. So why don't you give our listeners a bit more about your background and we'll dive in.
Yeah, sure. I'd love to. A little bit about my background. I started out in life with a very long and successful career working as a computer engineer. And I was working in the tech industry. I spent many years working at startup companies, technology companies. And what happened, Todd, was I watched my entire industry get flipped upside down because we had the dot-com boom and then immediately followed by the bursting of the dot-com bubble. And if you recall, right around that time, there was the September 11th terrorist attacks and all this turmoil in the world happening at that time. And specifically in my industry, because of the dot-com bubble, companies were going under. It was really, really bad for the tech industry. And that was another downturn that I went through in my career. And so it made me realize that I was way too dependent on the income from my job because my paycheck was my only income source. And I loved the work I was doing, but unfortunately, my job always was full of all these circumstances completely out of my control. And what I learned, Todd, was that no matter how good of an engineer I was or how valuable of an employee I was, if things were not going well at the company or in my industry, then I could quickly lose my job through no fault of my own.
Yeah.
And that was a huge risk. And I was very uncomfortable with that.
Yeah.
And so I decided that I wanted to get involved in investing to build up other income sources, cash flow. That was my main driver, my main goal. I want to learn how to build cash flow streams. And so with that, naturally, I turned right to alternative investments because alternative investments in general, it's all about buying and building assets that you own, you control, you can increase the value, and they generate income for you so that you get paid while you wait. And that was very appealing to me. So that was my entree into this amazing world of alternative investments. And I got started, like many people, in real estate, building up a rental portfolio. So that's
When'd you
how it
start
all
doing that?
started for me. When?
Yeah.
In the early 2000s.
Okay. In
Yeah,
that kind of bubble bursting time, you're like, hey, I
exactly.
got to do something here.
Yeah,
Yeah.
exactly. It
Yeah.
was
Well,
time to the pain was enough that it motivated me to make a change,
yeah, and that
right?
tech industry it's a beautiful industry. It's a big industry. Obviously, there's a
It's
lot
very
there,
cyclical.
but it's very cyclical. It's very high risk. I mean, I know a few people that are fundraisers for the tech industry and they
Mm,
consult the companies that they raise for. And their whole thing is like, we're going to invest in 20 companies and, a couple of them are going to get us our money back. and hopefully one of them is a grand slam and the rest of them are going to lose.
Yeah.
And that's the tech industry, and even companies that can get be successful. A lot of times it's for a time, and then they don't innovate quick enough or whatever happens. And so yeah, it's a highly volatile industry, amazing industry. I don't know a crazy
Yeah.
amount about it. You know way more than me, but I want to know, like maybe the top lesson, two, three, you know, that you learned working for these startups and going through that turmoil, like like lessons that you take and maybe use today in
Yeah.
your business, whether it's mistakes you saw being made, whether it's like good habits that you saw the successful companies do, whatever it might be. What are like a lesson or three lessons or, your top takeaways?
Yeah, that's a great question. I love that. So, couple things that skill sets and different lessons that carried over for me. So, as an engineer, naturally, um, something that's very important in the work I do, the industry I'm in now, which is the mortgage note industry, doing the analytics, the due diligence,
Yep.
the analysis, the evaluations, all of that. It's very systematic. So you get good at developing systems and processes, which that's a skill that's beneficial in any business and needs that. Right. And so that's something that naturally uh, I was always good at. But along with that, here's another one that a lot of people don't think about. And I saw this in several industries I was working in. Big companies that are successful never, ever give all their business to one vendor.
Mm,
They have diversification. Maybe they have a vendor for a large important function that they outsource to another company, or it's an equipment manufacturer or a supplier. They never have 100% of their locations of their sites running the same equipment, the same software, the same systems. Maybe they'll split it up 50-50 between two different competitors, or maybe they'll split it up 80-20 or 90-10, whatever it is. But they never have all their eggs in one basket. It's diversification, because you never know if a company goes under, or um, there's a supply chain shortage, or a
yeah.
business deal goes bad, business climate goes sour, and there becomes a hostile relationship, and changes have to get made. All of these real life scenarios. So I learned that. I learned that successful companies never give 100% of their business to one vendor. And so, how do we mitigate that risk? Well, you find two or three different vendors of the same function, and spread your business out that way,
Yeah.
right? If you're involved in multifamily, the multifamily space, right? So your different vendors that you might use for um, running and operating a large multifamily property. Maybe you have one main HVAC company that services and maintains your units. Well, it's a good practice to have two or three, have some backups, because maybe you have an emergency situation and your main company, they can't handle it right away. You can go to your backup. Um, and it just gives diversity that way. So this way, you're never going to ever get held hostage by a vendor or be severely impacted if their business were to go under overnight or anything like that. And I've seen this happen time and time in all different industries. Companies, they might not make it for one reason or another, whether it's mismanagement or a big lawsuit or a issue that's completely out of everyone's control, like a global pandemic or anything like that can happen. And so being prepared by spreading that out, it's diversification. It's the simple concept of diversification. If you're building a portfolio, you're going to diversify by investing
Yeah.
in a number of different, putting your capital among a number of different investments. That's always a good practice.
Yeah. Yeah, no, I love that, and it can be, used in any industry, right? And
Yeah,
even real estate, even investing. If I think about, my business and you think about your business, we're not investing in the exact same asset every single time in the exact for me specifically, I'm not sure certainly do I have the neighborhoods I like? Do I have the cities I like? Yes, but that's plural. I'm not investing in the same type of building in the same neighborhood and just that neighborhood only because if anything happens there, again, like you said, like you're going to go under. And so for everybody, it's just that a little bit of diversification can go a long ways.
for sure.
Uh awesome. Well, I really appreciate that. That's great. Um Fred, let's talk about let's talk about note investing. Not everybody completely understands note investing. So dive in a little bit. What types of notes are you buying?
Mhm.
First of all, what type of notes are you buying?
Yeah. I focus on residential mortgage notes.
Okay. And are they
Um,
distressed or
no,
non-distressed?
no, they're not.
Okay.
Um, and we buy nationwide. So getting back to that diversification
Yep.
aspect, we have geographic diversification across the whole country, um, which is really nice. It's something that note investing. You don't need to be near the property. You don't even need to see the property ever, um, and so you can invest anywhere you want.
Okay.
And when you get to a level where you're buying notes in quantity, they'll be mixed across different states, different regions. And so it's good to have that geographic diversification. Here's a lesson from the insurance industry, right? How do insurance companies work? They function and operate. Their business model is to insure not just a single insured, but a whole pool of insureds, whether it's people, properties, cars, whatever it might be. And so it's diverse, it's spread out. And yes, there'll be some claims here or there, but highly unlikely that all of the insureds
Yeah.
have a claim at the same time.
Yeah.
Right. And so that's a diversification. And so with notes, we have that as well. It's multiple payment streams. And while there may be an issue here and there, uh, the strength is in the numbers in the pool overall carries the weight and keeps the cash flow stable and current. And that's a very important aspect. I think this is across any investing. You never want to put all of your capital into one deal, right? Whether you're
100%.
buying properties, you're buying notes, you have $1 million you want to deploy into notes. Yes, you can go and buy one jumbo loan on a multi-million-dollar trophy property and have that one note. But wouldn't it be better to buy 10 notes that are at $100,000 each and spread your capital that way?
Right.
I right. It just makes
100%.
sense when you think about that. And so I always that's something I talk about in my book is this concept of diversification. It's very relevant in our space in note investing, but I think it applies to any type of investing. If you are a if you are an LP investor, right, in syndications, spread your cap, find a couple of good operators that you like and spread your capital out
Yep.
because there's going to be different timing, different risks, different payment schedules, all of that. And so spread it out a little bit. If you want to be an LP in mortgage note funds where you're investing in managed funds, you can spread your capital out the same way among different operators who
Yep.
have different business models, maybe different asset classes.
Yep.
It's really sound investment advice and skills that you can put to work, and you're leveraging the expertise of top class experts when you
Yeah.
do that.
Yeah. Love it. Love it. 100% agree. So you're buying these stable notes. Is it cash heavy then? Is there a
It
way
is.
to, because in, the real estate I do, I'm getting a loan so
Mhm.
it's still cash heavy, certainly, but we get a loan, we bring investors in. And so it's not as cash heavy on my end if I'm gonna, but is it cash heavy on the note? If I'm gonna buy $100,000 worth of notes, I got to come up with $100,000. Is
Yes.
that right?
Yes, that's correct. It
Okay.
is capital intensive, very. Um, so there is a discount on the purchase of a note. So you can
That's what I
buy
was gonna that
notes
was my next
for
question.
less than the amount of the debt,
Okay.
so depending on the risk characteristics and risk profile.
Why would somebody
But
sell you a loan that doesn't have any hair on it for less than full price?
yeah, this is a great question, Todd. Um, there exists a secondary market for loans, for mortgages. Mortgages are bought and sold every single day, and customarily they're sold at a discount.
Hmm.
And here's a very relatable scenario that I'm sure most of you listeners out there have experienced this. Have you ever gone and purchased a property or refied a property? You go to closing, you get the loan,
Mhm.
and then you start making your monthly payments. And wouldn't you know it, within 2 or 3 or 6 months, you get
Yeah, you're
that
paying
letter
somebody
from the
else.
lender saying, "Dear Mr. and Mrs. Homeowner, we're writing to inform you that your loan has been sold.
Yeah. Yeah.
And here's the contact information for the new lender starting next month. Send your payments to the new lender. And by the way, don't worry, none of the terms of your loan have changed.
Yep.
And here's our contact information and thank you." And so that loan got sold. Why is that? Couple reasons. Loan originators, they're in the business of originating loans. And so they want to recapitalize very quickly so that they can turn around the very next day and originate a new loan for someone else. And they make their money from the points and the fees and those first couple of months of loan payments, which, by the way, if you think about an amortization schedule, it's all interest basically, right? So the loan balance didn't go down that much, not at all in those first few payments. But loan originators, they work in such high volume and they need to keep turning that money over, the
Mhm.
velocity of money. That's their model. And so they'll sell those loans at a discount. But this happens at so many levels, even years after a loan exists. The loan might be part of a bond or part of a mortgage security, a Wall Street product. Those products get broken down, all the loans get sold off, they get recategorized, revalued. If there's higher risk on a particular loan for any number of reasons, that's going to warrant a steeper discount.
What would
And
be a
so,
higher risk beyond like the buyer or the owner of the note or whatever?
it,
Not making payments, right? What's
yeah, that's one area, right? Maybe the payment history is not clean.
yeah. But
Maybe the equity in the property is not where it should be any longer because it
sure.
changed. Maybe the borrower declared bankruptcy at some point in the
Mm,
past. Their profile has changed. Maybe there's an issue with the loan file, like some kind of problem with a loan, part of the loan documents are missing,
hmm,
or there's a title issue that came up that has to be cleaned up. All of these things are different problems that come up, and they can all be fixed. They can be addressed and handled,
yep.
but it's like anything else. It takes time and it takes money. For the investor that's savvy, that knows how to fix and handle problems, they can go in, buy the asset at a discount, put the work in, which is time and effort and money, and then increase the value of the asset,
Yeah.
right? Does this sound a little bit like a multifamily
Yep.
investor that goes in and repositions a property,
It's all the same.
right? There's problems there, but if you have the skills and the know-how, you can fix those, and it takes time.
Yep.
And so it's the same thing, and that's part of some of the strategies, the more advanced strategies, right? And it's like any other type of investing. The more experience that you have, the more comfortable you're going to be with handling bigger problems. Your network is bigger. You have access to more experts to help you, vendors to help you, specialists if you need to bring in help because you can't do everything yourself. No. But this is some of the things that impact a discount. But
Sure.
back to your original question, this is very customary in our industry.
How do you find like you coming in, how do you find a note? Like, obviously you've got relationships now, but when you
Yeah.
first started, or somebody that's wanting to first start, do they just like, you just call up your local US bank branch and go, "Hey, I want to buy, some of your loans. Can you sell some to me here? Hey, Wells Fargo, what do you got here for me?"
Yeah. It is relationship based for sure.
Yeah.
100%. It's one of the most important aspects of our business. And so I always tell people that are looking to get started, build those relationships. You have to go out, go to events, go to industry conferences, meet people. Maybe when you're starting out, you might invest in a note fund that's managed, and you have a relationship with the fund managers, and that's great. That's a great way to start. I see a lot of people doing that, but it's a matter of getting out there and building those relationships. A lot of loans are sold between investors. We buy loans from institutions, from hedge funds, from note funds, from individual investors, all of the above.
Hmm.
And it's not realistic to think that you're going to call up Bank of America or any other bank.
Yeah.
They do sell loans, absolutely. However, those big national banks, they're selling loans in these super large pools
Yeah. They're
with
not just selling.
thousands of
Right.
notes, and those are cash transactions, right? Actually, if anyone wants to go on Fannie Mae, Freddie Mac's websites, and they post in there for public disclosure the loan sales for the
Hmm.
prior quarter. It's all there, and you can see the size and magnitude of the
Wow.
transactions. It's huge, and they're all cash transactions. And so the
So
buyers of that are,
this is a
yeah,
trickle down thing, right?
it
I mean,
is.
it's you're seeing the big companies, they're selling it to a smaller company and package, and then that company's taking it and they're selling to even a smaller company and smaller packages, and it keeps on going down. Is that kind of
Yes,
accurate?
that's exactly what's happening.
Okay.
Yes. However, notes are an asset class that is accessible to anyone, as I
Yeah.
said. To individual investors, maybe you want to buy a couple of notes in your self-directed IRA or Roth IRA, which, by the
Mm.
way, is a great avenue to do that. Or you invest in a managed note fund. You can do that out of your IRA because you have the capital there. It's in cash. Now
Yeah.
you can deploy it and start building cash flow.
And that's probably I can imagine, because buying real estate, your own real estate in an IRA can be problematic, but I can see it not being as much of a problem as long as you do it right. Of course, there's always that disclosure. Got to do it
Yeah,
right.
no, absolutely. You have to
But
work with the
you're
right.
not you're not touching the property, and that's the biggest
Yeah,
aspect. If you're buying like a duplex and you're going in there and you're showing the property, you're doing maintenance, that's a big issue within your IRA. In this case, you're not physically going to that property, you're not touching that property. So I can imagine that would be a lot more safe, still, as long as you do it right. But
yeah. No, absolutely. You have to do it right. You have to follow the rules.
yeah.
The best advice that I can offer is align yourself with a good
Yes.
IRA custodian.
Hmm.
They will provide the guidance. They will keep you compliant because the last thing they want is to come under scrutiny because one of their account holders did some kind of a transaction that breaks the rules of investing in an IRA. And so they will be very beneficial in helping and providing guidance to keep you compliant. Um, but yes, you can own these types of assets. You're not allowed to do work on it yourself, but there's plenty of vendors, right? One of the most, let's talk about this, Todd. One of the most important vendors in note investing is loan servicers. Loan servicing companies, what do? They collect the payments on behalf of the lender. They send out the monthly statements. They'll take phone calls from the borrower. They send out the compliance notices. They send out the end of year tax statements that have to get sent both to the borrower who paid the interest and the lender that received the interest. And they do all of this for a low monthly fee. Typically, I see servicing companies charge between $15 to $30 a month
Hmm.
per loan, and it's very reasonable. And
Yeah.
think about it this way: a loan servicing company, the same way that a property manager manages a rental property on behalf of the owner, the servicing company manages the note on behalf of the lender. And so, utilizing good vendors, they become your business partners. And when you're investing out of an IRA, it's super important. And so I always recommend that. We use that in our business. We have all of our notes serviced by different servicing companies, whether they're owned in an IRA or owned in a traditional entity. But it's a very important and key service that's provided to us as investors.
Yeah. So, I mean, and it sounds like a no brainer for that price.
Yeah.
What are the risks? There's got to be risks in note investing. What
Mhm.
are kind of your top risks involved?
Yeah, there are definitely risks, and I'll talk about several of these. Um, and think about your experience as a borrower. Did you ever notice that when you take out a mortgage on a property, the bank always wants to set up an escrow account to pay your taxes, to
Yeah.
pay your insurance, to
Yeah.
pay your homeowners association? Why is that? Because any of those areas can become threats to the lien.
Mhm.
They can jump in front of the lien in priority.
Yep.
And so, if your property was to go delinquent in taxes because you weren't paying them and goes to tax sale, in some states, a tax sale wipes out all liens on the property. And so a bank is never going to let a property go to tax sale. They're going to make sure if the taxes get behind, they can step in. They have the right to. It's right in the mortgage documents. The lender can go in and reinstate the taxes at any time and then add that to the loan balance. The lender can go in and put in forced place insurance if your insurance lapses,
Yep.
because that's protecting their interest in the property.
Yep.
And they can add that onto the loan balance. Same thing with homeowners association dues. So the lender always, there's risks that threaten the lien, but there are steps to mitigate those risks. And so that's something that's very important. Now, other risks are compliance risks that can come
Mhm.
up. Laws can change that we have no control over. The government can come in the middle of the
Yeah.
pandemic and
Yeah.
make sweeping, broad changes and moratoriums that you have no say in the matter.
You
All,
had to be
all of
shaking
all
during
of
that time, right?
all of these things, right? And so those are some examples of risks that come up. And for someone that's new and inexperienced, sometimes it's a great option if you want to get involved in note investing. Invest in a fund. A fund lets you be involved. You're earning the cash flow and benefits of the investment, but your assets being managed by a team of professionals, and
Yep.
you get to leverage the experience, the expertise, the relationships. It's very key. And so that can be a great option. And so those are some of my favorite strategies for managing risk. I talk about this a lot in my book, um, because there are many different risks that can come up. So it's important to don't be afraid of them, but be aware. Having that elevate your awareness so that you understand what are the risks and what are the things that the steps that you can take to implement to mitigate those risks.
Yeah. Yeah. Good points. On that kind of wavelength here, what's a mistake that you've made? Doesn't have to be exactly like what you made in note investing. Maybe it's in business in general. What's a mistake that you've made, and how can you pass down a learning lesson to our listeners?
Yeah, great question. A mistake that I've made in the past was not doing enough due diligence on someone that I was going to go enter into a business
Mm,
transaction with. People, people get so focused on evaluating the deal,
yeah.
looking at the deal and all of that, the asset itself, which is, of course, important to do. However, don't neglect performing your due diligence on the other people involved. Is there a counterparty to the transaction?
Yep.
Whether you're buying a property, buying notes, buying a business, it doesn't matter. Um, whether you're a partner doing entering into a partnership or even a customer, do your homework, right? Check out some things. Do they have a good reputation in the industry? Are they a frequent flyer down at the county courthouse? Is there a lot of case history? Right? It's all in the public record. You can easily check that or
It's easy to ignore too.
hire someone to do it for you if you don't know how.
Yeah.
But I'll tell you something. I've seen investors get involved in the deals and transactions with the wrong people and they lost money. They opened themselves up to so much risk. And I always say this, if you would have spent 10 or 15 minutes Googling the other people, the entity, the principles of the entity, just to see what you find. Like a lot of these situations you could have avoided. You would have seen
Yeah.
things come up right away that are
Yeah.
red flags. And then you of course investigate further. But start with that. At a minimum, start with that. And then make sure you do your homework because getting into a business deal with the wrong person, you're going to lose money,
Right.
effort, nights
Potentially
of sleep,
reputation.
energy, like all of
Yeah.
these things, right? A bad deal, then you have to work on getting out of it and you lose money. But what about all the energy? What if instead you would have directed that energy and momentum and focus into a different deal that was profitable and really good, right? It's that opportunity cost that you lost. So very important, and that's a mistake I've made in the past. I've seen others make it as well. So do your homework first on who you're getting involved with.
Yeah. Yeah. You can, I mean, there's a lot that can go wrong. I mean, your reputation is everything. And if you decide this is especially if this is a business partner that you're going to be doing business with, and that person is just not a good person or is okay with doing some things that aren't okay, your reputation follows, right?
Yeah,
And it doesn't matter how ethical you are. If the people you surround yourself with are not, that's the reputation you get. So, and that's
absolutely.
everything to me. I mean, so yeah, great advice. In the name of your book was the Little Green Book of Note Investing. I think everybody, if you're at all interested in note investing, be curious about it.
Yeah.
Great book to pick up. Fred, I got a couple last questions before we wrap up here. What's a book that you could recommend to our listeners other than your own book, of course?
Wow, there's so many that come to mind. A couple, I'll give you a couple that I like. Start with Why by Simon Sinek. It's all about finding your purpose and getting into alignment with that. If you're looking for something that's a little more tactical and practical, um, that gives you actionable things to implement in your business, I love Atomic Habits by James Clear. That's another one that's fabulous. And I think everyone can benefit from reading that. And one that was really great for me was the Ultimate Sales Machine by Chet Holmes, because as an engineer, I was a tech guy. I never learned, or I never worked in sales. And that was a
Yeah.
skill that, as an investor, I had to get good at sales for raising capital, for um, doing business transactions. And so that was a great book for me to learn about the science and art, because it is both, of sales.
Yeah. Yeah. I think that is such a
I
valuable skill for people to learn.
It doesn't
Uh,
matter what you do, right?
doesn't matter. Quite frankly, if you are, look, great salespeople, it takes a lot of work and honing and I mean, that's a special gift and you got to really work at it. And I think quite frankly, I think part of that can become learned, but being great at sales, that some of that's like, being a great athlete. It just
Yeah.
comes naturally to some people, but everybody needs to learn at least how to be an okay salesperson and
And
just,
everyone can get better at it,
and everybody can
wherever
get
you
better
are.
at it.
Yeah.
Exactly. Exactly. I think it's such a valuable skill. In fact, it's something that I want both my kids when they get, out of the house to go and sell and learn how to fail at selling. They don't have to be sales reps for the rest of their lives, but just to learn how to do it. I think it's so important.
That's great
Um,
advice.
Fred, last question before we wrap. What are your 3 pillars of wealth creation?
Wow, this is a great question. Um, 3 pillars of wealth creation are access to capital.
Mhm.
The second one is your the people you surround yourself with, which is your circle of influence, the mentors that you have in your life, the people that you learn from. And the third one is your skill sets. And I always encourage people to be a lifelong learner. Always strive to learn something new. There's always a new skill that you can get better at, you can learn, whether it's reading a book or signing up for a workshop or seminar. Learn different skills that will help you in your business, in your personal and professional life.
Yeah.
Those are my 3 pillars.
One of the things I like to ask myself, and I got to be better at doing this, but one of the things I like to ask myself um, every evening before I go to bed is, what did I learn today? Like just one thing. I don't need it. Maybe I learned 30 things. Well, that's going to take me a while to dissect it, but just like, what's one thing that I learned today? And if you can't answer that question, it means you didn't try very hard that day. And you better wake up the next morning and figure out what you're going to learn, because I think what you just said there, education and just always being a lifelong learner, is so important. And of course, the other ones too, access to capital, surrounding yourself with the right people. I mean, those are all so important. Um, and we can ask ourselves what we're doing to get in front of those 3 things.
Yeah.
So
Well,
awesome, Fred. Really appreciate it. How can our listeners get in touch with you, learn more about what you got going on, and connect?
yeah, thank you, Todd. I always love connecting with investors, and hearing from listeners, hearing from readers of my book. So the best way to reach me is by visiting my website, which is fredmoskowitz.com. Now, I have a feeling that some people might prefer a little bit of an easier spelling. So, as an alternative, you can go to giftfromfred.com, and that'll take you right to my website. And once you're there, you can connect with me. You can request to receive a special report I have on note investing. I'm happy to send that out at no cost to anyone that wants it. And I always look forward to building relationships, connecting with people, learning what people are interested in the space of investing and alternative investments. So thank you
Love it.
so much for having me on today. It's been a great conversation, and I've really enjoyed it.
Yeah, Fred, look, really appreciate you having on. We'll put that stuff in the show notes as well as how to get your book too in the show notes. People can access that. And look, reach out to Fred. I mean, he came on this show. He gave us a ton of knowledge today. And yeah, I mean, he didn't come on the show just to be shy. He came on the show so he could teach you something and connect with him. So Fred, really appreciate it.
Thank you.
Lots of knowledge. Thanks a lot. And you have a fantastic rest of the day.
Thank you, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.